What if I told you the man who would one day become the richest investor in the world didn't start out with billions? Or even millions? In fact, Warren Buffett's first $1 million didn't fall into his lap. It was built piece by piece, dollar by dollar, in a way so unconventional, so calculated, that it almost feels like watching a magician at work. But here's the real question. How did he do it? How does a young man from Omaha, Nebraska, far from Wall Street's flashing lights, turn modest beginnings into a life-changing fortune before most people even hit their stride? This isn't just a story of money. It's a story of discipline, vision, and an almost obsessive commitment to seeing opportunities where others saw nothing. Buffett didn't stumble onto his first million by accident. He engineered it. And once you understand how, you'll realize the same principles could still work today. Because here's the thing, Warren Buffett didn't invent a new technology. He didn't inherit vast wealth. He didn't even take enormous risks. Instead, he cracked a code, one that blended patience, psychology, and math into a formula for wealth that would eventually make him a household name. And that first million, it wasn't just a milestone. It was the launchpad for everything that came after. Picture this. It's the mid-1950s. America is buzzing with post-war optimism. The suburbs are booming. Cars are rolling off assembly lines. Everyone wants a piece of the American dream. Yet in a small office in Omaha, a young Warren Buffett is hunched over piles of financial reports, pouring through balance sheets the way other men his age might flip through sports magazines. To most people, these pages are boring columns of numbers, ratios, and margins. But to Buffett, they are alive. They tell stories of hidden fortunes, of businesses selling for less than their worth, of opportunities just waiting for someone sharp enough to grab them. Still, opportunity is one thing. Turning it into $1 million? That's another story. This is where the mystery begins. Because Buffett's path to his first million didn't involve trading stocks every second of the day. He wasn't gambling on flashy new companies. He was quietly, almost invisibly, putting together a strategy that would shock those around him. And let me tell you, the closer he got to that seven-figure mark, the more resistance he faced. Friends doubted him. Some thought he was crazy for refusing to follow Wall Street's trends. Others couldn't believe he had the patience to sit on investments while everyone else rushed for quick wins. But Buffett had a secret weapon: time. He understood that money compounds like a snowball rolling down a hill, gathering size and speed as it goes. Most people wanted to chase after bigger snowballs. Buffett wanted to start small and let gravity and patience do the work. It sounds simple, but in practice, it required a kind of discipline most people can't imagine.
No shortcuts.
No lottery tickets, just relentless focus. Now here's the part that really grips you. Buffett's first million wasn't the result of one massive investment or a lucky break. It came from an entire system, a machine he built piece by piece. He created investment partnerships that pooled money together, applied his value-driven strategy, and then multiplied those dollars over time. By the time he crossed that magic number, his first million, Buffett wasn't just a rich man. He had proven something almost nobody else could: that you didn't need to be born wealthy or work on Wall Street to change your financial destiny. And that's what makes this story so important. Because in uncovering how Warren Buffett made his first million, we don't just get a biography. We get a roadmap, a set of timeless principles that anyone can adapt, no matter the era, no matter the market. But to fully understand this, we have to rewind. Before the million, before the partnerships, before the legend of the Oracle of Omaha, we need to go back to where it all began, to a young boy in Omaha who seemed destined for something extraordinary. And as you'll see, the clues to Buffett's first million were already there, long before he even knew it himself. Why should you care about how Warren Buffett made his first million? After all, the man is worth well over $100 billion today. Isn't the real story about how he built Berkshire Hathaway into a financial empire? That's the easy trap to fall into, focusing on the endgame, not the beginning. But here's the truth. The first million was the hardest. It was the mountain Buffett had to climb without a safety net, without a global reputation, and without the resources that later made his name legendary. And that's exactly why this story matters to you right now. Because hidden inside the way Buffett earned that first million are the timeless principles of wealth creation that still apply, whether you're starting with $100 or 100,000. These aren't Wall Street tricks. They're not get-rich-quick schemes. They're habits and mindsets that separate financial success from financial struggle. Let's pause for a second and imagine what making $1 million in the 1950s really meant. Adjusted for inflation, Buffett's first million would be worth more than $10 million today. For a man in his mid-20s living in Omaha, Nebraska, it wasn't just rare, it was almost unheard of. Millionaires existed, sure, but they were factory owners, oil men, or inherited heirs. Buffett was none of those. Instead, he was building wealth in a way few people understood. By buying pieces of businesses that were undervalued, patiently holding them and watching them grow. The lesson? He wasn't chasing trends, he was mastering patience. Now, think about the world we live in today. Everyone is looking for speed. Overnight success, a viral moment, a meme stock that turns pennies into fortunes. But Buffett's story reminds us of something almost uncomfortable. Wealth grows slowly. And that's why so few people achieve it, because waiting is hard. Yet, that's also why his first million is such a powerful case study. It shows us how discipline can beat desire, how logic can beat hype, and how long-term thinking can outlast short-term greed. But there's another reason this story matters. It's not just about money, it's about trust. When Buffett started his investment partnerships, he didn't have billions to attract investors. He had to convince family, friends, and neighbors to give him their hard-earned savings. Imagine the pressure of that. Imagine knowing that if you fail, you don't just lose your own money, you lose the money of people who believed in you. That's the hidden weight behind Buffett's first million. Every dollar wasn't just his. It carried the faith of people who put their trust in a young man with nothing but numbers and conviction. And here's the twist. Buffett didn't chase flashy gains to impress them. He did the opposite. He promised he wouldn't lose their money. That safety-first mindset became the cornerstone of his empire. And it's the exact opposite of the risky behavior most people associate with getting rich. So why should you keep watching this story unfold? Because in the next chapters, you'll discover the seeds of Buffett's empire. You'll see how a boy obsessed with numbers turned that obsession into teenage hustles. How a meeting with one legendary professor changed his life forever. How he built a partnership model so unusual it made Wall Street roll their eyes until it started printing millions. Most importantly, you'll see the decisions, setbacks, and turning points that created Buffett's first million. And once you understand those decisions, you'll realize this isn't just Warren Buffett's story. It's a story about how financial greatness is built. Slowly, deliberately, with discipline that almost anyone can learn. Because here's the truth. Buffett's genius wasn't about IQ. It was about temperament. And that temperament, calm, patient, methodical, is something you and I can choose to practice too. By the end of the story, you won't just know how Buffett made his first million. You'll understand the mindset that could help you build yours. Before Warren Buffett became the Oracle of Omaha, before Wall Street knew his name, there was just a boy in Nebraska with a fascination for numbers so intense, it bordered on obsession. This isn't the story of a child prodigy sitting in ivory towers. Warren was born in 1930, in the thick of the Great Depression, into a family that knew struggle. His father, Howard Buffett, was a stockbroker who later became a congressman. His mother, Layla, ran the household with a frugality that left lasting marks on young Warren. Money was scarce, and meals were sometimes skipped. The Depression wasn't just a headline in the newspaper, it was life in the Buffett home. And perhaps that's where it started, Warren's burning need to understand money. Not just to earn it, but to control it. By the age of 6, Warren was already experimenting with profit. He bought 6 packs of Coca-Cola from his grandfather's grocery store and resold each bottle door-to-door at a markup. Simple? Yes. But it showed a boy who already saw money differently. Not as something to be spent, but as something to be multiplied. At 11, while other kids were playing baseball in empty lots, Warren made his first stock purchase. 3 shares of Citi Service Preferred, 1 for himself, 2 for his sister. He bought at 38 a share. Within weeks, the stock fell to 27. Most kids would have panicked. Warren held on. Eventually, it climbed back to 40 and he sold. A tiny profit, but the lesson was huge. Because shortly after he sold, the stock soared to over 200. That sting of regret imprinted a rule Buffett never forgot. Patience pays far more than quick wins. What made Warren different wasn't just that he was hustling. It was the way his mind processed numbers. He would memorize baseball statistics with photographic precision, not for fun, but because he loved finding patterns in the numbers. He would study horse racing odds, calculating probabilities for profit. He even filed tax returns at 13, claiming deductions for his bicycle and watch, because he used them on his paper delivery routes. Imagine that, a 13-year-old not just earning money, but thinking like an accountant, an investor, a businessman, all rolled into one. And while other kids dreamed of becoming athletes, pilots, or movie stars, Warren had a different vision. At a very young age, he declared to friends, "I'm going to be a millionaire by the time I'm 30. To most, it sounded like a child's fantasy. But to Warren, it was a mission. Buffett's fascination with money wasn't greedy. It was logical. Numbers gave him comfort in an uncertain world. In the chaos of the Depression, numbers were steady, rational, and controllable. If you knew how to read them, they told the truth. He began devouring books from the local library, anything on business, investing, or markets. At 7, he checked out a book called 1,000 Ways to Make 1,000. He studied it as if it were scripture, jotting down ideas, imagining how each one could be scaled. He wasn't just reading, he was preparing. By his teenage years, Warren had dozens of small ventures. Selling chewing gum, delivering newspapers, setting up pinball machines in barbershops, and even running a small horse racing tip sheet. By the time he graduated high school, he had saved over $5,000, the equivalent of nearly $70,000 today. For a teenager in the 1940s, that was astonishing. But here's the twist. Even with all this success, Warren wasn't yet the Warren Buffett we know. He had the instincts of a hustler, the discipline of a bookkeeper, and the ambition of a dreamer. But the sophisticated investor, the man who could turn modest savings into millions, was still being forged. And fate was about to introduce him to the man who would shape that transformation. Benjamin Graham, the father of value investing. But before Warren could meet his mentor, his hustling teenage years would teach him one more powerful lesson: the difference between making money and keeping it. And as we'll see, those lessons would form the foundation of his empire. By the time most teenagers are worrying about dances or baseball tryouts, Warren Buffett was already running a mini-empire. He wasn't just a kid with a paper route or a summer job. He was an entrepreneur, obsessed with turning nickels into dimes and dimes into dollars. His teenage years weren't a prelude to success. They were a testing ground, a laboratory where he refined the instincts that would one day make him the world's greatest investor. Let's start with his newspaper routes. Warren didn't just deliver papers, he optimized the business. He memorized the streets of Omaha, reorganized his route for efficiency, and expanded his deliveries to hundreds of homes. At his peak, he was delivering over 500 newspapers a day, often waking up at 4:30 in the morning, trudging through snow, rain, or blistering heat. Most kids would have spent the earnings quickly. Warren hoarded his money. He invested it. He kept meticulous records of his income and expenses in ledgers that looked more like corporate balance sheets than a teenager's notebook. By the time he finished high school, his paper route alone had earned him more than most adults made in a year. But Buffett wasn't satisfied. The paper route was steady cash flow, but he wanted businesses that scaled. That's where the pinball machines came in. In 1945, at age 15, Buffett and a friend bought a used pinball machine for $25. They placed it in a local barber shop, offering the owner a cut of the profits. Within weeks, the quarters piled up. The kids reinvested their earnings, buying more machines, placing them in more shops. Within months, they owned several machines across town. It was brilliant. The machines earned money while Warren slept. He wasn't trading time for dollars, he was building passive income. By the time he sold the business a year later, Buffett pocketed over $1,200, a small fortune for a teenager in the 1940s. But the pinball machines were just one chapter. Warren tried dozens of other ventures. He sold used golf balls he collected from local courses. He peddled chewing gum and soda door to door. He bought 6 packs of Coke for $0.25 and resold each bottle for a nickel profit. He rented out a horse at county fairs. Every venture added to his growing pile of savings. At 17, Warren even tried his hand at real estate. He and a friend bought a used pinball machine business and then later a small 40-acre farm in Nebraska for $1,200, leasing it to a tenant farmer. Think about that. While his classmates were studying for prom, Warren Buffett was a teenage landlord. By graduation, Buffett's net worth had crossed $5,000, the equivalent of nearly $70,000 today. He wasn't rich yet, but for a teenager in the 1940s, it was almost unheard of. What's fascinating is not just the money itself, but the mindset behind it. Buffett never wasted earnings on luxuries. He reinvested relentlessly. Every dollar was a seed, and he wanted to plant as many as possible. He didn't just see a Coke bottle, he saw a margin. He didn't just see a pinball machine, he saw cash flow. To Warren, money wasn't for spending. It was for compounding. That's what separated him from his peers. Most teenagers dreamed of cars, dates, or college. Warren dreamed of balance sheets, profit margins, and becoming a millionaire by 30. And he wasn't just dreaming, he was building the foundation. But despite his success, Warren knew there was a ceiling to hustles. Selling Cokes and running paper routes could only take him so far. If he wanted to scale beyond thousands into millions, he needed knowledge. He needed a framework. That's when fate intervened. Because soon, Buffett would encounter the man whose ideas would change his life forever. Benjamin Graham, the legendary investor who literally wrote the book on value investing. Buffett's teenage hustles had made him money, but Graham would teach him how to build wealth. By the late 1940s, Warren Buffett was a young man with money in his pocket, ambition in his heart, and one burning question: how do I take this further? He had hustled his way into a small fortune by teenage standards: paper routes, pinball machines, and rental properties. But he knew instinctively that these ventures were just stepping stones. If he was going to reach his audacious goal of becoming a millionaire by 30, he needed more than hustle. He needed a system. That system, and the man who would deliver it, was Benjamin Graham. Benjamin Graham was not just another investor. He was the investor. Widely regarded as the father of value investing, Graham had survived the Wall Street crash of 1929 and emerged with a philosophy that turned chaos into opportunity. His 1934 book, Security Analysis, was like scripture for serious investors. Later, his more accessible The Intelligent Investor distilled his philosophy into simple but profound principles. At the heart of Graham's strategy was one idea: buy businesses for less than their worth. Look for undervalued companies where the market had mispriced the stock. Buy them with a margin of safety and let time correct the mistake. It wasn't gambling. It wasn't speculation. It was rational, disciplined investing. To Buffett, this was a revelation. Here, finally, was the framework he had been searching for. After high school, Warren enrolled at the Wharton School at the University of Pennsylvania but found it dull. He transferred back to the University of Nebraska, where he finished his degree in 3 years while working nearly full-time. By 20, he had read every book on investing he could find in the Omaha Public Library twice. But it was The Intelligent Investor that changed everything. Buffett later called it, by far the best book about investing ever written. He didn't just read it. He absorbed it, line by line, until its principles fused with his own instincts. When Buffett learned that Graham was teaching at Columbia Business School, he knew he had to be there. Against his father's initial wishes, Warren enrolled. It was 1950, and he was about to meet the man who would shape his destiny. Imagine it, a young, wide-eyed Warren Buffett sitting in a lecture hall at Columbia, listening to Benjamin Graham explain concepts like intrinsic value, margin of safety, and Mr. Market, the allegory Graham used to describe the stock market's mood swings. For Buffett, it was like discovering the missing piece of a puzzle he'd been building since childhood. All his hustles, all his experiments with money, they had given him raw experience. But Graham gave him the map. Warren wasn't just a student, he was a disciple. He earned the highest grade Graham had ever given in his classes. He devoured every lesson, every case study, every principle. And when he graduated, he was determined to work for his hero. But here's the twist. Graham didn't want him. Buffett begged for a job at Graham Newman, Graham's investment firm in New York. He wrote letters. He visited. He pleaded. But Graham turned him down. Why? Because Graham had a strict rule. He only hired Jewish analysts at the time, believing it was his responsibility to give them opportunities when Wall Street shut them out. Buffett, a kid from Omaha with no Wall Street pedigree, didn't fit. For most people, that would have been the end of the road. But Buffett's persistence, and perhaps fate, wouldn't let it go. After returning to Omaha to sell securities for a while, Buffett finally got the call. Graham relented. He offered Buffett a job at Graham Newman in 1954. The pay? $12,000 a year, good money at the time, but nothing compared to the value of the apprenticeship Buffett was about to receive. At Graham Newman, Buffett learned investing the way a surgeon learns medicine, by watching a master at work. He analyzed companies, dug through balance sheets, and applied Graham's margin of safety philosophy in real markets. One of Graham's favorite plays was buying cigar-butt stocks. Companies so cheap they still had one puff left. These were businesses in decline but undervalued to the point that investors could still squeeze out profits. Buffett embraced the strategy, making money on tiny, overlooked companies that others dismissed. But while Buffett absorbed Graham's methods, he also began to feel the limits. Graham's style was brilliant, but it was mechanical, numbers on a page, bargains for bargain's sake. Buffett's instincts were pushing him further. He wanted to invest not just in cheap stocks, but in great businesses that could compound wealth for decades. Still, without Graham, Buffett might never have made it to his first million. The discipline he learned under his mentor became the bedrock of everything he would do next. And soon, Buffett would take Graham's lessons back to Omaha, mix them with his own vision, and create something new. A model so radical it would change the course of his life forever. By 1956, Warren Buffett was back in Omaha. He was only 25 years old, but he had already lived the life of an investor many times over, paperboy, hustler, stockbroker, and protege to Benjamin Graham. Now, with his mentor retiring from Wall Street and closing his firm, Buffett faced a choice. Stay in New York and chase the glamour of Wall Street, or return home and carve his own path. He chose Omaha, and that single decision would change the course of financial history. Most young men at 25 are still figuring life out. Buffett wasn't most men. He was ready to build something new, something uniquely his. He had about $174,000 of his own money saved, equivalent to over $1.5 million today, thanks to his hustles and years of disciplined investing. But he knew that building serious wealth required scale. He needed more capital to put his ideas to work. And that's when Buffett invented a model that was as radical as it was brilliant: the Buffett partnerships. Here's how it worked. Buffett invited friends, family members, and neighbors in Omaha to invest with him. But this wasn't a traditional fund. Buffett structured it with rules that protected investors and gave him the freedom to execute his strategy. The terms were simple but unusual. He would take no management fee. He would only earn if he outperformed the market. Specifically, he'd take 25 of any profits above a 6 annual return. This was revolutionary. Unlike most fund managers, Buffett wasn't paid just for managing money. He was only rewarded for producing superior results. It meant his interests were perfectly aligned with his partners. If they didn't make money, neither did he. At first, only 7 partners joined him, pooling together $105,000. It was small, modest, almost laughable compared to Wall Street's big firms. But Buffett wasn't aiming for size. He was aiming for performance. What made Buffett's partnerships radical wasn't just the structure, it was the strategy. Instead of chasing glamorous stocks or hot industries, Buffett stuck to Graham's value philosophy but with his own twist. He sought out companies trading for less than their true worth, businesses overlooked, misunderstood, or neglected by the market. But unlike Graham, Buffett wasn't satisfied with cigar butts alone. He wanted businesses with durable potential, companies that could keep compounding for years. And from Omaha, far from the noise of New York, he had an advantage. He could think clearly, He wasn't caught in the frenzy of Wall Street. His office was small, his lifestyle modest, his focus absolute. Buffett once joked that he liked Omaha because he could invest with a foot on the desk and no shoes on. But beneath the humor was truth. Distance gave him clarity. At first, few people understood what he was building. Even family members were skeptical. Could a 25-year-old kid from Nebraska really outperform Wall Street's best and brightest? Wasn't he too young, too inexperienced, too far from the action? But then the results started rolling in. Year after year, Buffett's partnerships crushed the market. While the Dow Jones returned modest single digits, Buffett posted double-digit gains, sometimes 20, 30, even 40 in a year. The small pool of 105,000 grew. Word spread. New partners joined. The capital base expanded. And Buffett? He was calm, steady, almost boring in his approach. No flashy offices, no secret formulas. Just a relentless focus on numbers, discipline, and the belief that value always wins in the end. But here's the key. These partnerships weren't just about making money for Buffett. They were his launchpad. With each passing year, as the partnerships grew, his own share of the profits ballooned. By his early 30s, he wasn't just managing other people's money. He was rapidly building his own fortune. And somewhere in those quiet Omaha offices, the snowball began to roll. Buffett had created a machine that compounded money faster than almost anyone thought possible. It wouldn't be long before this machine delivered him to his first million. But the road wasn't without obstacles. Skeptics questioned his methods. Markets tested his patience. And even as his fortune grew, Buffett had to make decisions that would shape not just his first million, but the empire still to come. By the early 1960s, Warren Buffett was no longer just a curious kid from Omaha or a promising disciple of Benjamin Graham. He was running a growing network of investment partnerships, commanding the confidence of neighbors, relatives, and increasingly wealthy backers. The snowball was rolling, but the question lingered. When would it cross that magical line? $1 million? The answer is more fascinating than you might think. Buffett's first million didn't come from one bold bet, one lucky stock, or one big break. It came from a disciplined, methodical accumulation of small, consistent wins, applied over and over, magnified by time and compounding. Building blocks of the first million when Buffett launched his partnerships in 1956 with 105,000 from 7 partners, his own capital was modest. But he set the terms so that if he outperformed the market, his share of profits would grow disproportionately. Year after year, that's exactly what happened. The Dow Jones averaged about 7 annually during this period. Buffett, through his careful selection of undervalued companies, averaged more than 25 a year. Think about that difference. A partner investing $10,000 with Buffett could see it double in just 3 years. And Buffett himself, because of his performance fee and his own invested capital, was watching his wealth multiply at a breathtaking pace. The moves that mattered, so what specific investments pushed him across the $1 million mark? One of his strategies was to buy into tiny, neglected companies nobody else cared about. For instance, he invested heavily in Sanborn Map Company, which made maps for fire insurance. The business itself was stagnating, but Buffett noticed something no one else did. Sanborn owned a massive portfolio of stocks worth more than the company's entire market value. By buying shares of Sanborn, Buffett was essentially buying one worth of assets for 70 cents. When the market corrected, Buffett and his partners made a fortune. Another play was in Dempster Mill Manufacturing, a struggling farm equipment company. Buffett bought control of the company, replaced management, and unlocked hidden value. It was an early taste of the activist style he'd later perfect with Berkshire Hathaway. Then there were the workouts, as he called them, special situations like mergers, liquidations, or reorganizations, where he could make quick, low-risk profits. These weren't glamorous, but they were effective. Each deal might only yield 5 to 10 returns, but stacked together, they compounded into serious gains. The quiet millionaire by 1962, the math was undeniable. Buffett's partnerships had swelled to more than $7 million in assets under management, and his personal stake had crossed the threshold. He was worth over $1 million. But here's the part that shocks most people. Buffett barely celebrated. There were no parties, no champagne, no luxury purchases. For him, the first million wasn't an endpoint. It was validation, that his system worked, that his snowball had momentum, and that bigger things were inevitable. In fact, Buffett later admitted that while the first $100,000 felt almost impossible to scrape together, after that, the million came surprisingly fast. And once he hit $1 million, he already had his sights set higher. Why this first million was different: most people who hit $1 million through business or luck often see their fortunes evaporate. Buffett's was different because it was built on principles, not chance. He never risked everything on one stock. He never relied on trends or fads. He reinvested relentlessly. And above all, he protected his downside. By the time he reached his first million, Buffett wasn't just rich, he was unstoppable. He had proven that his partnership model, his discipline, and his philosophy could scale infinitely. The first million was proof of concept. The billions that followed were simply execution. But of course, success never comes without resistance. As Buffett's wealth and reputation grew, so did the skepticism. Many couldn't believe that a quiet man in Omaha could consistently outsmart Wall Street. Some warned that his style wouldn't last, that the market would humble him. And indeed, challenges were waiting, because the road from 1 million to empire was littered with obstacles, setbacks, and decisions that could have easily derailed him. Every great success story has its shadows, the doubts, the resistance, the tests that separate those who stumble from those who rise. For Warren Buffett, the journey to his first million wasn't a straight climb upward. Even as his partnerships flourished, he faced challenges that could have broken lesser investors. It's easy, looking back, to see Buffett's early years as inevitable, a clean trajectory from small hustles to financial mastery. But at the time, the outcome was anything but certain. Buffett wasn't yet the Oracle of Omaha. He was just a young man running obscure investment partnerships out of a modest office in Nebraska. And to many on Wall Street, that seemed laughable. The skeptics from the beginning, Buffett battled skepticism. Investors in Omaha trusted him. Family, friends, neighbors, but in New York, the financial elite dismissed him. Who was this kid, operating far from the action, claiming he could beat the market year after year? Some called him lucky. Others accused him of cherry-picking obscure stocks that no serious investor would touch. His deep value approach, buying into companies that were cheap, boring, or even failing, seemed outdated in a world obsessed with growth and glamour. Even some of his own partners questioned his methods. When he poured money into the Sanborn Map Company, people were baffled. A map maker? Really? But Buffett's conviction was unshakable. He knew the value was there, hidden in plain sight. That kind of conviction is rare and lonely. The fear factor: then there was fear. Remember, Buffett's strategy wasn't about chasing quick gains. It was about patience. That meant buying stocks, sometimes in bulk, and waiting months or even years for the market to recognize their worth. But markets don't move in straight lines. They crash. They surge. They test your nerve. In 1962, just as Buffett's partnerships were hitting their stride, the market plunged. Stocks dropped across the board. Investors panicked. Some called Buffett desperate for reassurance. Others wanted to pull out. Buffett didn't flinch. He reminded his partners of his rules. We don't lose money, and we don't follow the crowd. While others sold in fear, Buffett doubled down, buying even more of the undervalued companies he believed in. It was a turning point. That discipline, refusing to let emotions dictate decisions, set him apart. When the market recovered, Buffett's results soared. Early setbacks and lessons: of course, not every investment was a win. Buffett made mistakes. Take Dempster Mill Manufacturing, the farm equipment company he bought control of. Buffett saw value in its assets, but the business was struggling. For a time, it drained his energy and capital. He had to bring in new management and restructure the company just to make it work. That experience taught him a crucial lesson. Not all cheap companies were good investments. Some were cheap for a reason. He began to refine his philosophy, moving away from cigar-butt investing and toward businesses with stronger fundamentals. There were also personal obstacles. Running partnerships wasn't just about numbers, it was about people. Buffett had to manage not only money, but expectations, egos, and anxieties. Some partners wanted faster results. Others questioned his secrecy. Buffett famously never told them exactly what he was buying. They had to trust him blindly, a demand that created tension. The weight of responsibility, perhaps the greatest obstacle of all, was invisible. The weight Buffett carried on his shoulders. These weren't faceless investors. They were people he knew, neighbors, relatives, friends of his parents. Every dollar he invested was someone's savings, someone's dream of a better future. If he failed, he wouldn't just lose money. He'd lose trust. He'd lose reputation. And for a man who built his life on integrity, that was unthinkable. So Buffett lived with constant pressure, but he transformed that pressure into discipline. He refused to gamble. He refused to compromise. He played the long game even when it made him look foolish in the short term. And that's the lesson hidden in Buffett's obstacles. Success isn't about avoiding setbacks. It's about enduring them without breaking your principles. By facing fear, skepticism, and early mistakes, Buffett didn't just protect his first million. He hardened the philosophy that would guide him for the rest of his career. But here's the real twist. Those struggles didn't just shape his money. They shaped him. They transformed Buffett from a clever hustler with great ideas into a disciplined investor with unshakable temperament. And that transformation would be the key to everything that followed. By the time Warren Buffett crossed his first million, he was more than just a successful young investor. He was beginning to transform, from a Graham-trained bargain hunter into the Buffett we know today. The patient, disciplined legend who could see decades into the future. But this transformation didn't happen overnight. It came from experience, setbacks, and an evolution in his philosophy. It's the difference between a clever stock picker and a financial legend. Outgrowing Graham's shadow, Buffett adored Benjamin Graham. He often called him his greatest teacher. But as he gained experience running his partnerships, Buffett realized Graham's cigar-butt style, buying cheap, broken businesses just for one last puff of value, had limits. Sure, it worked. Buffett made plenty of money buying companies trading far below their asset values. But those companies often required too much effort. They were messy, weak, and hard to grow. Buffett began to see that there was a better way. Buy wonderful businesses at fair prices, not just fair businesses at wonderful prices. This was a radical shift. Instead of just looking for discounts, Buffett started looking for quality.
Durable brands.
Strong management. Businesses with moats. The competitive advantages that protect profits over the long term. It was a transformation that would define his career. The influence of Charlie Munger. Around this time, Buffett met a man who would become his closest partner and intellectual counterweight, Charlie Munger. Munger challenged Buffett to evolve. He pushed him to think bigger, to go beyond Graham's mechanical formulas. Munger argued that buying mediocre businesses just because they were cheap was short-sighted. Instead, they should seek out companies that could grow and compound for decades. Buffett listened, and slowly his strategy shifted. This was the beginning of the Buffett-Munger partnership that would shape Berkshire Hathaway into one of the greatest conglomerates in history. From trader to builder, another key part of Buffett's transformation was how he saw himself. In his early years, he was more of a trader, buying stakes in undervalued companies, waiting for them to rise, then selling for a profit. It was lucrative but transactional. As he matured, Buffett started thinking like a business owner, not just a stock picker. He asked, "Would I want to own this company forever? Do I trust the people running it? Does it have a lasting edge over competitors?" This mindset shift, from trading pieces of paper to owning businesses, was revolutionary. It moved Buffett beyond clever deals into true wealth creation. The temperament factor, but perhaps the most important transformation, was internal. Buffett realized his greatest edge wasn't his IQ or his ability to crunch numbers. It was his temperament, his ability to stay calm when others panicked, his discipline to wait years for the right opportunity, his refusal to let greed or fear dictate his decisions. This temperament turned him into something rare in finance. Predictable, steady, almost boring, and yet devastatingly effective. While others chased fads, Buffett quietly compounded wealth. While others bragged about quick wins, he thought in decades. And soon, that patience began to look like genius. The seeds of Berkshire Hathaway by the early 1960s, Buffett's partnerships were booming. His reputation was spreading, and he stumbled across a struggling textile mill called Berkshire Hathaway. At first, it looked like another Graham-style cigar, but cheap assets in a dying industry. But Berkshire would become something much greater. It would become the canvas on which Buffett painted his life's work. But here's the key. Buffett was ready for it because of his transformation. The boy who once hustled pinball machines had become a man capable of building a financial empire. The clever investor had become a legend in the making. And that's what makes this phase of Buffett's story so powerful. The first million wasn't just about money, it was about growth. It was about the evolution of a philosophy, the sharpening of a mindset, and the birth of a legacy that would inspire generations. But perhaps the most valuable part of the story isn't what Buffett achieved. It's what we can learn from it. Because buried in the story of that first million are timeless lessons that apply to anyone who dreams of financial freedom. Warren Buffett's first million wasn't just a number on a balance sheet, it was a proof of concept. It showed that discipline, patience, and clear thinking could turn small beginnings into life-changing wealth. And while the world has changed since the 1950s, the principles behind Buffett's success remain as powerful as ever. So, what can we take from his journey? What timeless lessons lie inside the story of his first million? 1. The power of patience. Buffett's first million wasn't built overnight. It wasn't the result of one lucky stock pick or one explosive business deal. It was the outcome of steady compounding over time. In his early days, Buffett himself admitted that the first 100,000 is A.B. It's hard, feels slow, but once that base is built, compounding takes over like gravity pulling a snowball down a hill. His story is proof that wealth is less about speed and more about consistency. In a world addicted to instant gratification, Buffett reminds us that patience is still the ultimate financial superpower. 2. Protect the downside. One of Buffett's golden rules is simple: don't lose money. His partnerships were designed not just to seek profits, but to protect capital. He didn't gamble with his partner's money. He didn't swing for the fences. He looked for safe, undervalued opportunities where the odds were stacked in his favor. This mindset, minimizing risk before chasing returns, was the bedrock of his first million. And it's a principle anyone can apply. Focus on avoiding mistakes before chasing big wins. 3. Think like an owner, not a trader. Buffett's transformation from Graham cigar bargains to quality businesses revealed a profound shift. Great wealth comes from owning, not trading. When you think like a business owner, you stop worrying about daily stock prices. You start asking deeper questions. Does this company have a moat? Can it endure for decades? Would I be happy owning it forever? That mindset gave Buffett investments that kept compounding long after others had sold. 4. Integrity builds trust. Buffett's first million wasn't his alone. It came through partnerships, family, friends, neighbors, people who trusted him with their savings. And Buffett honored that trust by aligning his interests with theirs. He didn't charge management fees. He didn't get paid unless they made money. That integrity built loyalty and allowed him to scale. The lesson? Money flows to trust. In business and in life, character compounds just like capital. 5. Location doesn't limit you. Buffett built his empire not in New York, not in Chicago, but in Omaha. Far from the noise, far from the temptation of fads and speculation, he created clarity. His story proves you don't need to be in the center of the action to succeed. Sometimes, distance gives you the focus you need to win. 6. The temperament advantage. Finally, Buffett's edge wasn't IQ, it was temperament. Anyone can learn to read balance sheets. But not everyone can stay calm when markets crash. Not everyone can resist the urge to sell too soon. Not everyone can endure years of waiting for an idea to pay off. Buffett could. And that's why he won. As he often says, the stock market is a device for transferring money from the impatient to the patient.